Welcome to the Diversified Financial Planners 2016 Federal Budget presentation. There's a lot of content to go through. However, this is just going to specifically discuss superannuation measures that were introduced. I'll do my best to make this as quick as possible for you. So just to kick it off, a disclaimer, obviously this is not personal advice, this is just general advice based on our interpretation of what was conveyed through the federal budget, and if you wish to take any action based on this, our strong suggestion is that you go and seek professional advice before making any of those decisions. Right, so superannuation was targeted pretty heavily in the budget, so let's kick off with the 1.6 million pension cap. Like many of the other measures introduced, this takes effect from the 1st of July 2017. Having said that, just be aware that these are not legislated, they're announcements, and they do have to become legislated before they actually will properly take effect. And also, just to throw a spanner in the works, we do have an election on the cards shortly. So technically it's called the super transfer balance cap. So one of the things that we've found already that's caused a lot of concern for people that have more than $1.6 million is, am I only allowed to have 1.6 in savings in our super balance? The answer to that's no. You can still have whatever balance you've got now. So if you've got $2 or $3 million, you're still allowed to have that. It's just that the first 1.6 mil is the only thing that will be subject to the tax-free earnings. Anything in excess of that will be taxed at a maximum rate of 15%. Effectively, it will be become an accumulation account, and the tax rate is 15%, less the effect of any franking credits or depreciation from property, depending on what sort of investments you've got in the fund. One thing that was clearly stated, though, which is a bit of an advantage, is if you've got $1.6 million and the value increases with investment earnings, then the value that will be tax-free will be the entire balance. So if you've got 1.6 mil and it grows by $200,000, the full $1.8 million will be tax-free. There was no mention of penalties if the balance drops below the 1.6 million and you top it up by transferring money from the accumulation to the pension account. We assume that that would be a likely proposition. However, there's no clarity at this point, and obviously as things become legislated, there will be a bit more detail and answers for some of these questions we've got. Just a strategy for self-managed funds is, one thing we'll look at is the segregation of assets. So we'll put investments that produce a high level of income into the pension account where they'll be tax-free, and assets that produce a low level of income, not growth, income, or zero income, such as a block of land, we'd leave that in the accumulation account. Because clearly if there's no income coming from it, then the tax is going to be zero. So that will be a smart move straight off. There was no mention of indexing. So really from this point forward, we can only assume that this $1.6 million pension cap will remain as it is for the foreseeable future. Just to have a look at how it looks. So I've just done some figures here. Currently, based on various different amounts that you may have in your super, currently everything's tax-free. Going into the new regime from 2017, you can see the figures for yourself. Obviously at 1.6 there's no tax, and then as the balance increases further down the line, you can see the effective tax on the balance. Now I've assumed a 5% rate of earnings on the excess amount over the 1.6 mil and tax that at 15%. Transition to retirement. Now this is something that's going to affect quite a few people. Again, takes place in 2017, so we still have 14 months of this strategy. What the government is saying is that the earnings on transition to retirement income stream pensions will no longer be tax-free. They're going to be taxed the same as a super account at that rate of 15%. They're saying that it won't be tax-free until you retire. Unfortunately, we haven't seen a definition of what retirement is. So at the moment, we can't assume that retirement means just automatically turning 65. So we'll have to assume that if you keep working and using a transition to retirement pension beyond 65, that the earnings will still be taxed as an accumulation account. Common sense would say it shouldn't, but until we see more detail, that's what we have to go with. Now, some people are lucky enough to have an unrestricted, non-preserved pension, which is a accounts-based pension rather than the transition to retirement pension, where there's no restriction on the amount of money they can take out. Formerly, what we've been able to do with people aged between 55 and 60 is to take the money out as a commutation or a withdrawal and have that money satisfy the minimum pension requirements. The government come out and said, no, that no longer has to happen. If you want to satisfy the minimum pension, you need to take a pension payment. We are unsure whether this is retrospective to people that have current account-based pensions that are in that age bracket of 56 to 60. There's no mention of the pension tax offset on the income for those people between 56 and 60 because pension income is taxed at their marginal rate at that point. And there's no mention of the pension being income exempt or tax-free after the age of 60. We have to assume at this stage that both of those would probably still exist. Again, until we see clarity, we won't be able to be. Right, this $500,000 lifetime cap on personal contributions is causing quite a lot of angst and concern amongst people. Now, this applies from budget night, and they are actually counting the contributions, your personal contributions you've put in since 2007. Now, what they're saying here is that if you've put in $200,000 in the last 9 years, then you've got $300,000 that you're allowed to put in to super over the rest of your life. However, on the other hand, if you've put in $800,000, they're not going to sit there and penalise you because you've gone $300,000 over that $500,000 lifetime limit. They're basically just going to ignore that and say, yes, we understand you've met your lifetime cap, and from this point forward, anything you put in addition, will now become an excess contribution. Just to put some perspective on it, the rules prior to the budget were that you could put in $180,000 a year, or you could put in $540,000 over a 3-year period using a bring forward provision. So you can see it's actually quite a large difference in what the rules formerly were to what they now are. Now, if you do happen to put in excess contributions, so whether deliberately or unintentionally, you can have the option to just remove them without penalty, or you can leave the contributions in there and be subject to a penalty tax. At the moment, we actually don't know what that rate is, but I'm going to assume it's the marginal tax rate, which seems to be the way it will be. If that's the case, it would obviously be wise to remove those excess contributions unless you're on a 0% tax rate. They've given us some nice provision, at least by indexing this cap with the Australian Weekly Ordinary Times earnings. So that's a more generous indexation than inflation. This does affect recontribution strategies, and it's probably something that needs another discussion. But in brief, most people have got a taxable component in their super funds. That taxable component tracks a death duty effectively when you die and leave the money to a non-tax dependent. A non-tax dependent does not include a spouse, but generally would be children over the age of 25. And that tax is 17%. So if you've got $100,000 of taxable component in your fund, then there's $17,000 worth of tax that's paid. The recontribution strategy that we used to use, we used to take money out of the super fund that was taxable, put it into your personal bank account, then put it back into the super as a personal contribution. It would then become a tax-free component, and that would reduce that $17,000 tax or that 17% tax and make that zero. The reduction of the concessional contribution cap, so this is employer contributions or personal deductible contributions. So we're looking now at a situation that from 2017 that will reduce to $25,000. At the moment, or formally, the rules are that if you're under age 50, you can put in $30,000 a year, and over it's $35,000. So for everyone that's going to reduce to $25,000, Again, just to put some perspective on this, back in 2007 it was 100,000, so it's a fairly large reduction we've seen over that time. The small business capital gains tax concessions will still apply, so for those of you that have got small businesses that are going to retire or sell up and put proceeds into super, good news there that there's not going to be any penalty for doing that. Now, this was a pleasant surprise. The removal of the work test again takes effect from 2017. So it is saying that people beyond the age of 65 up to 75 will no longer have to meet this work test in order to be able to make contributions into super. So that's a big win for a lot of people. Certainly as people get into that age bracket, they start to receive inheritances at a more reasonable rate than normal, and sometimes there's other windfalls as well. So it just gives people that ability to still contribute to super without having to satisfy this 40-hour in a 30-day period test that's required. Now, removal of the 10% rule. So basically this is, again, in 2017, the 10% rule means that if you receive more than 10% of income from employment sources, then you're not eligible to make a deductible super contribution. So the removal of this rule now allows anyone to make a deductible super contribution, really, regardless of their work status. Now, this is handy because those people that were previously entitled to use this were sole traders, people in partnerships, and unsupported people, or people that were no longer employed, either due to retirement or just that they were out of work. So previously they were able to do this contribution. However, this now opens it up to workers. And I know that we've got clients that are unable to salary sacrifice because of work arrangements and rules around their pay. So effectively they can now make these personal contributions, claim a tax deduction, and it would be the same effect as if they salary sacrificed. So that's a big win. Plus also there's some people that don't trust their employer to pass the money on to super, or don't want their employer knowing that they've got the ability to salary sacrifice, so that they don't get their wages crunched or reduced pay increases in the future. Another benefit of this is some capital gains tax planning, which I'll go through in a moment. The spouse super offset's not been a big winner over the years, but they've actually made this a little bit more attractive. So currently, if you put in $3,000 to a spouse account where a spouse earns less than $10,800, then you receive a rebate of $540 to offset your own tax. So what they've done is increase this $10,800 threshold to $37,000. So it's going to open it up a little bit more. So again, generally it's been the wife that has the lower income, and so it's just going to encourage people to put that $3,000 into the account and claim that tax rebate. The beauty of this figure of $37,000 is we might be in a situation where both the husband and wife are able to contribute to each other and get that rebate that I talked about. Now, the anti-detriment benefit abolishment. Now, this is something that a lot of people won't even be aware of that exists, and a lot of people will go, what the hell is an anti-detriment benefit? So in my mind, this is actually quite nasty for everyone, or I should say for a lot of people. Now, not all super funds pay an anti-detriment benefit, so I need to be clear on that, but there are some that do. Now, what these funds that make this payment actually do is they make an additional payment upon the death of someone where the proceeds of their super or pension are paid to a lump sum. So let's use the example of a child over 25 again. So you die, the money goes to that child, and we pay that taxable component that we talked about, that 17% tax. So this anti-detriment benefit essentially offset that 17% tax, which was quite a nice thing. So the child would have received pretty much the entire account balance. Whereas now with this no longer being payable, it means that the child is just going to receive the account balance less that 17% tax on the taxable component. Going back to that person with $100,000, it's going to be $17,000 less in the account for that person. So effectively, a death tax is going to apply. Now, $100,000, I think you'll find a lot of people have got more than $100,000 of deductible contributions or taxable contributions in their fund. In fact, I spoke to a couple today. Both of them had about $300,000. So if you throw that one in, there's quite a bit of tax there. Now, self-managed funds are also going to be significantly hit with this one. A number of funds have got reserves set aside, especially for anti-detriment payments. The reason for that is that there used to be some pretty meaty tax deductions available to the fund when they paid it. So we just have to be aware that that's no longer going to be available, and we may actually have to start paying some of the reserves out elsewhere. Catch-up concessional contributions. So this was a nice surprise to see this one in. Again, from 2017, was seems to have been aimed at people on parental leave, women and carers. But however, it does apply to everyone that's got a balance less than $500,000. So what they're saying is unused concessional caps or deductible caps will be carried forward for 5 years. So that means if you don't use the $25,000 in a year, then next year that $25,000 will carry forward with the next 25, so you'll have $50,000. And as you can see in this example here, let's say someone was on parental leave for 4 years, so there was no money going to super. So technically, on the 5th year, if they had the ability, they could put in $125,000 of salary sacrifice money, or a dump in if they're a business owner, or a personally deducted contribution, and that would get a full tax deduction. So that's actually quite a nice one. And the other thing here is it's going to help out business owners. Obviously, business owners have ups and downs with their incomes. Some years they have good years, in which case it'll be handy to be able to use this unused cap. And then in the poor years, I'll be able to bank that money up for the good years in the future. Really quickly on Division 293, surcharge tax effectively on incomes. So this is an additional 15% tax that applies to deductible super contributions. Formerly, it would only applied to incomes of over $300,000. So they've just now said that anyone that's got an income over $250,000 is going to be subject to that additional 15% tax, bringing the total tax to 30% for those. The low income super tax offset, again from 2017, effectively means that for people that are earning less than $37,000, the mandated 9.5% super guarantee that the employers pay, that will receive an offset to offset the contributions tax up to that amount of $500. So nice thing there for people earning under $37,000. Basically just means any money the employer pays at that point, you won't pay contributions tax on. Right, so just into a couple of strategies quickly before I finish up. So look, we can still make these maximum deductible super contributions until July 2017. So that's for people under under 50, 30,000 this financial year and next financial year. For those over 50, then it's 35,000 in each of those years before it goes down to 25,000. Just with that 1.6 mil in the pension, we can do that some segregation of the assets. So that segregation of putting the high income earning assets into the pension phase and the low income assets into accumulation, that's a bit of a bonus then. And with the way segregation works is you make that election at the start of the year. So if you've got that block of land that I mentioned earlier, if you've got that and think you're going to sell it in the next 12 months, then we can actually move that segregated asset over to a pension asset at that time. Top-ups of the 1.6 mil cap if the fund depletes, so that's something that we're hoping we're going to be able to do. Now, superannuation splitting with a spouse. Now, this is something that's been able to be done for quite a number of years now, where you can split your employer contributions or deductible contributions with your spouse, less an allowance for tax. So this brings us back to a situation prior to the old RBLs that we had, where we wanted to try to keep a husband and wife's funds as close to evenly balanced as possible. Don't forget, we've got this $500,000 lifetime cap, but that applies to both of you. So it's each. So that effectively allows $1 million of money to go in. And with the pension cap, the $1.6 million, again, that applies to both. So if we can get the balances roughly 50-50, then you're in a scenario where you've got $3.2 million for a couple that's tax-free. The spouse contributions become more accessible. That's that if you put the $3,000 into the spouse account, so let's not overlook that. I don't want to say specifically overcoming the $500,000 lifetime cap, but if we use a self-managed fund loan and we use that provision to buy an asset, and let's say we have a loan of $500,000 to buy an investment property in the super fund, then when the super fund finishes paying that loan off, there's an extra $500,000 of asset that the super fund then owns. So effectively, we're able to get more money into super by doing some leverage. Now, capital gains tax reduction when selling investment properties or shares with this ability to make personal deductible super contributions. So this is with that removal of that 10% rule, now allows people that are employees, when they sell an investment property, if they haven't used that $25,000 deductible limit or the concessional contribution cap, then it will allow them to be able to put a deductible super contribution in to help offset some of the capital gains tax. And furthermore, if we extend that to that catch-up contribution where you've got the 5 years of any unused concessional cap or that unused $25,000, then if you have a scenario here, if you don't make those additional contributions and you sell a property, then you've got the opportunity to make one large contribution and significantly reduce the capital gains tax on these growth asset sales. As I said, also the catch-up contributions are handy for the business owners and people on parental leave. Now, just very quickly, our services include self-managed super funds. That's something I specialise in and work in day to day. Transition to retirement planning. We've got a great team of planners that are all very capable of helping with these other strategies. Superannuation. Look, difficult strategies that require technical expertise, that's something that we love to get our teeth into. Investments, wealth creation, risk protection. We've got quite a large range of insurers that we're able to utilise there. Estate planning, aged care, banking and mortgages, and margin lending for equities, and redundancy. So that's pretty much us. Here's our contact details for anyone that's interested in trying to touch base with us. So our address, phone number, feel free to give us a bell and have a chat to one of our planners. Have a look at our website, send us an email if you wish, or track us down on Facebook. Thank you.